Hi, my name is George Dagnino. I'm the editor of the Peter Dac Portfolio. What I'd like to show you a very important relationship that is going to tell us what kind of market we're going to have in the next several months. And this is about the relationship between bond yields and stock prices. The blue line, this one, is the S&P 500. The orange line is the 10-year bond yields. It's a very important relationship, and the relationship is as follows. A bottom in bond yields is followed by a peak in stock prices. This is a typical relationship. Those who follow what I write and what I've been saying is a classical relationship between a lagging indicator and a leading indicator. A bottom in interest rates is followed by a peak in a leading indicator like the stock market. So a bottom in treasury yields is followed by a peak in the stock market, with the market declining from 4,800 to 3,600 as yields rose from 3.5 to 4.2, 4.3. But what is important is also you see that when yields eventually, towards the end, further sharp rise, they were followed by a decline in stock prices. Here yields, you see they bottom before a peak in stock prices. They rise and eventually the stock prices decline. And after the market declines quite a bit, then yields decline. So there is this lead lag between bond yields and stock prices. So let me show you. The yields rise, they're followed by a decline in stock prices. Yields have been rising and they're followed by a peak in stock prices. The peak in stock prices is followed by a peak in yields over the very short term. What is important now in this period here, after September 24, the yields have been rising quite sharply from 3.7 to 4.2. Now this is a big rise, and it says that eventually the market will have to correct. But the important feature is that the longer it takes for yields to have an impact in stock prices, the more pronounced is going to be the decline. Like here, it took almost 6 months in 2021 for yields rising to cause a peak in the stock market. But when the peak came, it was very sharp. Here it took around 3-4 months, not a big lead, but it was still a 10% decline. So now the yields have been rising for 2 months, so at least a correction of 5 to 10% is in the cards. The more yields rise, the sharper is going to be the correction. I will update this chart because of your interest. Well, I thank you very much, but I have to add one more thing. You can enjoy and profit from videos like this one by becoming a member of the Peter Dac Business Cycle Academy. We have 3 levels of membership: videos plus the financial updates and market updates, and the membership number 3 with the Peter Dac Portfolio, which is twice per month and is 22 pages long, plus the videos, plus economic and market updates.